Hey everyone, welcome back to another dividend investing video. As a dividend growth investor, one of my favorite things is when companies I invest in or the companies I follow announce a juicy dividend boost. Recently, I've pinpointed 3 dividend stocks in particular who just put out higher than expected dividend raises, and these are high quality businesses, the buy and hold kind of stocks I like to invest in. And today we're going to dig into each one of these companies and see if they are enticing buys right now. Now let me know down in the comments if you own any of these dividend stocks or if you are looking to start a position. I'm Nick and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm so we can bring you more quality dividend investing content. The first stock we're going to look at today is the Hershey Company, ticker HSY. And just kidding on the background music. I know you guys didn't like that last time. So on February 8th, Hershey's boosted its dividend payout by 15%. This is the second time in the last year Hershey's has announced a dividend raise. Their last was a 15% raise in July. So this is a company growing their dividend by 30% in just the last year. That's pretty crazy. Hershey's is serious about returning shareholder value, and these are the kinds of companies I love. Shares skyrocketed upon the announcement, which came with Hershey's Q4 2023 earnings call. They reported mixed results. They missed on the top line by $60 million, but did beat on the earnings per share by 6 cents. And they warned high cocoa prices are going to cut into their profits. So expectations for 2024 have been somewhat muted. Hershey's has 14 years of consecutive dividend raises, although they've been paying this dividend uninterrupted for 93 years. It was maintained during the recession between 2007 and 2009. So in that context, amazing track record with a 5-year average annual dividend growth rate of 9%, and over the last 20 years, an average growth rate of 10% per year. Wonderful stuff. Now shares jumped 4% on the news of this raise on the 8th that day. But this company has been a dog in the market over the last year. Shares are down 18% over the last year period. I think these last few months have been a unique opportunity to acquire a long-term stake in a wonderful business that for a long time was pretty pricey. The PE has plummeted in the last year. Right now, shares are trading at a forward PE of 21.1. This is a 15% discount to the 5-year average PE of 24.3. Right on. And by dividend yield theory, shares are also looking undervalued. The current yield of 2.68% is 32% better than the 5-year average yield of 2.03%. So this is looking like an opportunity to me. The dividend makes up 49% of forward earnings and 53% of forward free cash flow, leaving plenty left over to be used in other ways as well as growing their dividend. That dividend is able to grow thanks to Hershey's stellar job of increasing its free cash flows. Now, SimplySafeDividends.com has assigned Hershey with a dividend safety score of 93, rated very safe, highly unlikely to face a dividend cut. Now, about that dividend, Hershey's pays out quarterly in the months of March, June, September, and December, paying $1.37 per share for a total annual payout of $5.48 per share. To get a piece of that dividend with that 15% raise, you just have to have your shares by February 19th to get paid on March 15th. Hershey's isn't a company that does huge buybacks, but they're removing a small amount of shares every year, about 1 million. Now, 10 years ago, there were 227 million shares outstanding. Today, there are 206 million. So a slow decrease, but most importantly, no shareholder dilution. And looking solid in terms of return on equity and return on invested capital. Both are signs that we have prudent management. They have a track record here of superb capital allocation, doing right by shareholders. The average analyst price target is $208.84. That's about 3% upside from where shares are today, illustrating that perhaps there will be some bumpiness ahead for Hershey's. Maybe a prolonged stretch here where the resourceful and patient dividend growth investor could build out a decent long-term position in this wonderful and tasty business. That's Hershey's. The next stock we're talking about is Tractor Supply Company, ticker TSCO. I think this is the first time I've ever discussed this company on the channel, but they just announced a juicy dividend raise of almost 7% on February 6th. This is the 15th consecutive year the rural lifestyle retailer has increased its dividend payment. We have a 5-year dividend growth rate of 28%, average annual dividend growth. It's remarkable, although clearly it has slowed down with this latest raise. But it's still a respectable 7%. It definitely catches our attention. So let's talk about Tractor Supply. This is a retail chain. They operate 2,200 stores in 49 U.S. states. They sell home improvement, agriculture, livestock, and other goods for farmers, ranchers, to the folks in rural America who do the hard work that keep us fed. Shares in TSCO, they're basically flat over the last year, returning 0.25% from 1 year ago. But Tractor Supply has performed nicely over the last decade with a 10-year total return of about 300%, significantly outperforming the S&P 500 over the last 10 years. Remember that past performance doesn't guarantee future results. As far as timeliness goes, by PE ratio, TSCO is at a forward PE of 22.6. This is slightly above the 5-year average, so it doesn't look like we're necessarily in discount territory, maybe slightly above fair value by this metric at least. Although by dividend yield theory, TSCO is 30% above the 5-year average yield, suggesting that perhaps Tractor Supply is undervalued right now. Today, shares are yielding 1.9%. Now, Tractor Supply's dividend looks reasonably safe to me, 43% of forward earnings, 56% of forward free cash flow. In terms of free cash flow, it was getting a little high there for a couple years, but for the next 12 months, it's looking to be back under control. And by the way, the free cash flow here, this trumps earnings when looking at payout ratios. If you want sustainable dividend growth most of the time, right? You need growing free cash flows. Free cash flow per share has grown steady. This looks like a company that has really benefited during COVID, which makes a ton of sense if you think about it. So perhaps it came back down to earth, but the next 12 months look nice. Simply Safe Dividends give them a safety score of 68 for Tractor Supply. It's on the lower side of their safe rating, unlikely to face a dividend cut. As far as getting in on that juicy dividend hike, have your shares by February 23rd to get paid on March 12th in the amount of $1.10 per share. That's the total annual payout projected to be at $4.40 from here, and Tractor Supply pays out on a very common quarterly schedule of March, June, September, and December. In addition to healthy dividend hikes, Tractor Supply is also steadily buying back shares every year. There are 110 million shares outstanding today, while there are 139 million back in 2014. Return on invested capital is at 21%. They consistently outperform by ROIC, although they were stronger at this 10 years ago. One concern here is with the majority of retailers is thin margins. It's actually not that bad though when you're looking at some of their peers, comparing them. 10% operating margin, 4% free cash flow margin. It's not great, but it's also on par for Chorus and retail. Analysts see about 3.5% upside with Tractor Supply over the next 1 year period. Wall Street isn't particularly bullish on this one right now, but I think it's an interesting choice that deserves a closer look. Tractor Supply, while not the most exciting business, is one I see a definite need for. They did comparatively well in the last recession, so that's Tractor Supply with its latest 7% raise. Love it. The next stock I'm going to highlight, Chevron Corporation, ticker CVX. On February 2nd, Chevron boosted its dividend payment by about 8%, bringing Chevron's dividend growth streak to 37 consecutive years. Not to mention, Chevron has been paying this dividend without interruption for 112 years. No dividend cuts in more than a century. So there's something to be said about that type of track record. Still impressively strong as well. The 5-year average annual dividend growth rate for Chevron is 6%. So this new 7.9% raise certainly exceeded my own expectations, particularly in a time where we're seeing more and more companies tightening their belts, being more conservative with their dividend boosts. But as a shareholder, I am here for it. Look at the price of gas on this photo. Wouldn't it be great to go back to gas under $3? Well, gas prices, they are what they are. They're affected by the price of crude oil and the amount of supply there is to meet demand. So investing in Chevron or any oil and gas company, their performance is largely going to be tied to the price of oil, for better or for worse, making these companies highly cyclical. But I think Chevron and Exxon, ticker XOM, these are the two largest oil and gas firms, both very solid companies, very solid choices if you want exposure in that energy sector. But since Chevron just raised its dividend, that's who we are talking about right now. Over the last year, shares of Chevron are down a little over 9%. Shares are about halfway between the 52-week high and low, right around the midpoint. Looking at the last 10 years, Chevron has outperformed its peers with a 105% total return. Of course, none of these companies even come close to beating the broader market over the last decade, so it's really up to the individual investor if they want to allocate some portfolio space to oil companies or not. There's lots of opinions on this topic, but we can decide for this on ourselves. Every investor situation is different. I think if you're more inclined to want some income, you're more inclined to probably invest in these kind of companies. And I think right now, for most metrics, Chevron looks to be near fair value. We have a forward PE of 12.1, right in line with the 5-year average. Also right in line with the energy sector median. By dividend yield theory, shares are 4% above the 5-year historical norm, suggesting fair value. Shares are yielding a juicy 4.23%, So this is a nice dividend stock. The dividend makes up 51% of forward earnings and 54% of forward free cash flow. And there's plenty of coverage for the dividend, plenty of room for it to continue to grow as they just announced. And Simply Safe Dividends gives Chevron a dividend safety score of 90, rating it very safe, highly unlikely to see a dividend cut. Now you need to have your shares before February 15th in order to get the next dividend payment of $1.63. This will be paid to shareholders of record on March 11th. Chevron sticks to the popular March, June, September, and December quarterly payout schedule, paying $6.52 per share annually. Now, as a shareholder, I'm very pleased to see the job management has done to reduce its debt load over the last few years. Net debt to EBITDA is at 0.31, and net debt to capital is a mere 9%. So that's a great position for Chevron to be in going forward. Return on invested capital I would call acceptable at 13%. It does exceed the 8% preference we have for oil producers, so it's pretty solid there. But the graph really does illustrate the cyclical nature of Chevron's business. We have an average analyst price target, $177.53, so analysts see about 15% upside from where shares are today. That's Chevron there with a near 8% dividend raise. So out of this group we talked about, I think Hershey's definitely looks pretty good from a valuation standpoint, probably the most attractive. I really wish I owned shares in that one. Another stock I want to talk about real quick here is Disney. This came out with a 50% dividend hike, and while this is great, sounds great at least, keep in mind guys, Disney would need to boost their dividend by another 100% just to get back to where it was pre-pandemic, so call me unimpressed so far. But we'll continue watching Disney and all the other dividend-paying companies out there, giving you the best analysis we can. Next, I want to show you guys 3 more dividend growth stocks I think look to be undervalued right now in the month of February. Click into this next video, if you don't mind a little background music, to find out about these 3 fantastic companies. Thanks so much for sticking around, and until next time, keep investing.